Matt Hassan, thanks for joining us.
You're welcome.
Well, we've had what can only be described as a disastrous summer so far in terms of both bushfires and now the coronavirus. Let's start off talking about the impact of the coronavirus on both the Australian and global economies. Westpac has put out a statement this week on its view on the impact of that virus.
That's right. Obviously, this is a moving picture. It's a day-to-day case at the moment. So, our assessment is very much an initial assessment, shaped on the experience of the 2003 SARS outbreak, although it already looks like this particular outbreak will have a more meaningful impact than that particular period. But we're trying to get a sense of the sensitivities, what it may mean for China, the global economy, and in turn for Australia. The bottom line is that, on an assumption that the worst of the shutdown and disruptions maybe lasts a month and a half, it looks likely to see China's growth stall flat in the first quarter, lowering with a rebound thereafter, lowering growth to around about 5.3% for the full calendar year. Obviously, the risks here are to the downside, that it's a more severe event that has a more long-lasting disruption. But the sensitivities there look to be taking growth down towards 5.3, the low fives. In terms of the global economy, it's probably the order of a 0.1 or 0.2. We think that takes global growth down to around 2.8. For Australia, it's a meaningful impact. China's our largest trading partner, and this event will clearly have a direct impact on key sectors like tourism and education. Some real uncertainties around the nature of that impact. So again, it's a watching brief. And we do see some impact coming through our goods trade as well, and also through consumer confidence and spending domestically. All up, we think that's going to knock about 0.4 off growth on top of a shock from bushfires in the first quarter of about 0.1. That takes GDP growth to about dead flat for the first quarter. But again, with both of these shocks, we will get a resumption of normalisation over the course of the year, and with the bushfires, you'll get a rebuild, possibly also a stimulus effect from the state response to the coronavirus in China. So for growth over the course of the year, we think it takes about a 0.1. The coronavirus takes about a 0.1 for the full year. Now, we have a pretty downbeat starting point for the Australian economy. We think this is going to be even before these events, we thought this was going to be a difficult year for Australia. We see this as taking growth down below 2% to 1.9 for the full 2020 year, obviously with some lift thereafter. But for what is a difficult starting point for Australia, these are pretty unwelcome shocks.
Did it surprise you that RBA Governor Phil Lowe this week said that overall the bushfires and the coronavirus won't have a negative impact on the Australian economy this year?
The view for the central bankers is about the medium-term impacts. And as I said, we do see this as being a fairly negligible impact for the full calendar year. What concerns me a little bit here is that the risks are clearly to the downside with particularly the near term. And perhaps the risks, if you've got a starting point for growth that is on the weak side rather than around trend, so Westpac's view being of growth around 2% rather than near trend, then the risks are perhaps a little bit more intense. So, for example, if we were to see a larger hit to consumer confidence, that may last longer and that may restrain any sort of rebound that comes through. Likewise, if the labour market gets blown materially off course in the first half of this year, then I think there's a few more risks around that. For the full year, I think that's the correct approach, but perhaps there's a case here for being prepared to take out a bit of insurance.
Is the RBA Governor, do you think, being too positive about the Australian economy at the moment?
So our view is that this is going to be another challenging year for Australia. We don't see the global backdrop as being anywhere near as positive as the RBA's call at the moment, particularly now that we have a virus event in play. And domestically, we think that the consumer is going to be much slower to come right, and that the stimulus from previous policy easing will be fairly delayed and muted. So we think this is a more challenging environment for the Australian economy, and we think there is a case for further policy easing this year. And in fact, that's required to get us back on track in 2021.
Now, there was an interesting story in The Australian this week with members of Cabinet reportedly frustrated by the RBA after a briefing on Monday in terms of both his suggestions for fiscal policy, but not enough detail around that. Do you think it is the role of the RBA governor to be suggesting fiscal policy, and is enough being done by the government?
Clearly, the RBA's job is to set monetary policy, and I think the concerns that are being expressed relate to the limited power of monetary policy to generate an upturn. We have had very low interest rates for a long time now, and the economy is still sort of sputtering along. And getting key sectors, particularly around, the main thematic that the RBA governor has been highlighting is the disappointing picture around business investment. And that's a very hard part of the economy for monetary policy to reach. The main channels for monetary policy are the real interest rate sensitive segments, the consumer and the housing sector. The housing sector is clearly, it's working, but the wider consumer doesn't seem to be responding in the same way. So to get enough of a lift in those segments to in turn drive business investment to come to the party, if you like, is very difficult. I don't think the RBA governor is really formulating fiscal policy. What he's in a sense calling for is a shift in thinking. So fiscal policy does act. It has an important cushioning effect on the automatic stabilisers that we see over the course of the cycle. So if we were to see a downturn, or even another example is the bushfires. The deployment of aid is a sort of an automatic stabiliser that helps support growth. What he's calling for is thinking about what I would describe as a discretionary fiscal stimulus. So that's a big departure in thinking for the federal government over the last 15 to 20 years, where that kind of idea has not been part of the main thinking about policy. But given those restraints or the constraints around monetary policy, that's something that should be considered. We think it should be considered, that it's not simply about getting the framework right, that there's a timing issue here that fiscal policy could play a better part in.
Now, you mentioned the bushfires and their impact on the economy. Do you think spending around the bushfire reconstruction will act as a sort of stimulus itself?
I think it's offered an opportunity for one thing, which is helpful, which is to move away from prioritising budget surpluses. So that was a pretty clear statement from the Prime Minister in response to the bushfires, that his priority wasn't to maintain, to achieve a surplus, it was to deal with this crisis. And so I think in the first instance, it's telling us that that shift in priorities means that we're not going to see essentially further fiscal tightening, which would be a move to even larger surpluses. So at least that drag effect is out of the picture. But I think that change in thinking around the role of fiscal policy in terms of a discretionary fiscal stimulus hasn't really happened. I think, yes, you've got a case now for some fiscal expansion in terms of the response to the bushfires, but it's still about cushioning an additional shock to the economy rather than something over and above that might generate more momentum.
Now, interest rates remain at record lows at 0.75%. Governor Lowe was pretty defensive this week, it should be said, on his decision to make those cuts last year. What are the impacts on housing, do you think, and what are the risks there this year?
Certainly, from the RBA Governor's comments, there is a bit more attention now being given to risks in the housing market and what that may lead to with credit and household debt levels. More so, I think, around what further interest rate cuts might do to that risk profile. Certainly, the response of the housing market is pretty clear now. We've seen a very quick rebound in the Sydney and Melbourne markets. We're now seeing strong price growth. Melbourne's almost clawed back all of its price correction. Sydney's probably still about 5% off. We're also seeing it shooting through more clearly in turnover. So for a while there, it was a very thin market at very low levels of turnover. Now turnover's clearly rebounding as well. And the momentum is pretty well placed. We think that price growth will taper a little bit this year, but that will remain solid positive. So from the RBA's point of view, they can tick off policy generating an upturn in the most interest rate sensitive segment, and that may be weighing more on the other balance of risks in their assessment around further policy measures. They'll also be more confident, also clearly more confident that housing construction will start to pick up again in the second half of this year. We're a little less confident that will come through, but certainly from the RBA's point of view, this is one area that is following the usual path of policy responses.
Matt Hassan, thanks for joining us.
You're welcome.